on to the next phase of our game of accounting, all sports require that we keep score. The primary way that we keep score in the game of accounting is to use accounts like holding bins. Each account is like a box that holds information until we're ready to report on the results. There are different kinds of accounts for different kinds of reports. Asset accounts show what we own, liability accounts show what we owe, and equity accounts show what's left over. These three types of accounts are shown on what's called a balance sheet report, and we'll be looking at that in more depth shortly. We use several other types of accounts for an income statement. Income, or gross income, is what you charge for the work you do. Cost of goods sold is a special type of QuickBooks account, and we use it for the costs related to production work. Examples include the cost of labor and related labor burden, job materials, subcontractors, other direct job costs, as well as some non-job specific production costs such as gas, licenses, and insurances for your production vehicles and equipment. We also have expense accounts, which is where we'll accumulate the costs you incur to run your company. The other income account type is for income that's not related to your construction activities. Snow plowing and rental might be good examples, and other expense accounts are used to accumulate non-production types of expenses. So, in summary, we use accounts and reports to keep score for your business. Keeping up with our sports analogy, all sports have to deal with timing and internal debates and opinions. In the game of accounting, we have cash versus accrual accounting, as well as the construction industry variations to deal with. So let's first of all talk about what is cash basis accounting. Well, basically, cash basis accounting views income as funds received and costs as funds paid out. I like to think of this as checkbook accounting, because if you look in your checkbook, you can see the money that came in and the money that left. Now, that's not always the case, because perhaps the owner's taken money out or put money in that doesn't relate to the business, or a loan has been received or paid, so those funds are not really income or expense. But if you think of the checkbook as cash basis, that's probably the easiest way to remember the concept. Cash basis reporting is often used for tax reporting because it's easy and it can be manipulated to some extent. So, for instance, with cash basis accounting, when you get near the end of the year, you could go out and pay for a quantity of office supplies or a batch of materials in order to be able to reduce your taxable income for the current year. Of course, as I mentioned, not all cash out is considered to be expense, so you should talk to your tax advisor to understand all the implications. Most accountants and most management consultants agree that the cash basis of accounting is not a good measure of business activity or profitability, because it only relates to what you put into the checkbook and what you took out, not to what activity was performed or what it may have cost you to perform the activity. For example, let's say you took on a job in December and you put in 2 weeks of hard work. You wrote a check to the hardware store for $1,300, and you put $1,000 on account at the lumber yard. You invoiced your customer for $4,000, but you didn't receive any payment before the end of the year. On a cash basis, you've earned $0 because you didn't receive anything from the customer, and you've spent $1,300, so you'd have a $1,300 loss. But in fact, you actually earned $4,000 for the work you actually performed, and you spent a total of $2,300 to produce the work. The $1,300 for the check, as well as the $1,000 on account at the lumber yard, for a total of $2,300. So you actually earned $1,700, the $4,000 minus $2,300. Quite a difference from the cash basis. The other primary basis of accounting is called the accrual basis of accounting. There are two major concepts that you'll want to note here. The first central idea is that you recognize income based on the value of the services you've rendered or actual sales that you've made, and not on the amount of cash received. For example, those services might be project fees for work that you've completed and invoiced but haven't yet been paid for, or you may have actually closed on a home sale this month, but the new owner is going to be paying you over time. Income that you've earned but have not received money for is shown on the balance sheet as an asset called accounts receivable. I think I should also mention another important idea here. Please realize that this doesn't mean that if you go out and sign a contract and don't do anything to earn the money, that you should count it as income. A contract does not become income until it's earned. That is to say, until you've performed the work. You'll recognize it on your books as income as you complete the various stages of what you've agreed to do. The second core concept in accrual accounting is called matching. It means that you should show on your books the costs that match or that you incurred to produce that income. Costs incurred but not paid are shown on the balance sheet as a liability titled accounts payable or accounts payable trade. A variation on the accrual basis of accounting is percentage of completion accounting. The basic concept here is that we match our income to expense incurred. So if we've incurred 20% of our cost on a particular job, we want to make sure that we're showing 20% of the anticipated income for that job. So how do we make that happen? With special adjusting entries. We'll cover the percentage of completion approach in much more depth in an upcoming webinar. Then, from a tax standpoint, here's how cash and accrual accounting works. The first year that you filed a tax return, you or your accountant made an election to indicate how you'd be filing your returns every year. You may have chosen the cash basis, the accrual basis, or some other variation related to the construction industry, such as percentage of completion or completed contract. This election stays with you pretty much forever unless you go through some special process to get it changed. The good news is that you can choose to keep your books in a way that's different from your tax return and just have your tax accountant make adjustments to meet the tax requirements. This means that you can design your accounting system to meet your needs rather than continually having to look at your reports from an IRS viewpoint.